Hi, in this class, we will cover adjusted present value APV. Adjusted present value model APV is very important in alternative asset management. Also, it is very important when capital structure changes dynamically. In order to access this class material, go to Google and then type my name, Hyung-Goo Khan, and go to the Google site and go to teaching, and you can go to alternative investment here, and then here you can find adjusted investment. So there is folder and there are some good material. First I will cover this PDF file here, this one, exactly the same one. Okay, I'll cover this one. Okay, so I'll explain mathematically the adjusted present value model, and I will explain APV with a numerical example. Okay, what is APV? Adjusted present value. The adjusted present value APV method is a valuation technique. So it is valuation technique, something like NPV, IRR. But that explicitly separate the value creation process into two components. That's the interesting part. So first part is the value generated by the project operation, as if it were financed entirely by equity, and the incremental value or cost resulting from financial decision. So in some sense, we when we evaluate a firm, we separate valuation into two parts: value created by operational engineering and the value created by financial engineering, right? So in that way, therefore, by using APV, we can see the clear picture of where value arise. Okay, so suppose you are a private equity manager, you acquire a firm, and you have to value up, and you have to sell the company at higher price. Then you have possibly two strategies. Actually, you have three strategies. Okay, governance engineering, operational engineering, and financial engineering. Governance engineering is another part. But about operational engineering and financial engineering, okay, well, by using AFB, exactly how you can create value through your strategy. So this is particularly important for private equity firm. Actually, it is also important for other companies as well. But anyway, this approach is particularly useful when financing has a significant and dynamic impact on project value, such as when considering tax shield from debt, cost of financial distress, or subsidized financing. Again, it is particularly useful when it becomes important to separate the effect of financial engineering and operational engineering in value process. Okay, mathematically, the APV is expressed as a sum of two parts: operational value and financial value, right? Value from operational engineering and value from financial engineering. First, value from operational engineering is basically the sum of unlevered value. Okay, it is a value of the firm. What if there is no financial engineering effect, which means there is no debt? And then another part, the value creation from financial engineering, it is the present value or financial effect. Present value of financial effect or financial engineering. So APV is the sum of value of unlevered firm, VU here, plus a PV of financial effect or financing effects. Let's delve into the mathematical formulation of each component. First, unlevered value. This is more difficult part, okay? It is operational part. So this is basically benchmark case, the base case. Suppose a company has no debt. The unlevered value, unlevered means no debt. The unlevered value, VU, represent the value of the project or company as if it were financed solely with equity. i.e. with no debt. It is the present value of the unlevered free cash flow. In short, here UFCF, unlevered free cash flow, UFCF. And then we have to discount it, right? Discount it at the unlevered cost of capital, which we denote here as RU. Next, okay, then what is the unlevered free cash flow, UFCF? The UFCF is the cash flow available to all investors, both debt and equity holder, before considering any financing costs like interest payment. So for a period T, UFCF can be defined as UFCFT. We start from EBIT, earning before interest and tax. EBIT, earning before interest and tax, is important because it is earning, it is profit available to all stakeholders, right? Equity holders, debt holders, and then government. Government is important stakeholder. Okay, so we take out the government part. So we multiply 1 minus tau. Here tau is corporate tax rate. And then now when we do valuation, we need cash flow, not accounting profit. We have to do cash flow basis. So we add back depreciation. Depreciation is purely accounting cost, so we add it back because we don't actually pay it. Minus net working capital. Change of working capital is earning. Okay, change of net working. If net working capital increases, it is a profit, but it is not cash, right? So we subtract change of net working capital. And then capital expenditure like investment. Well, it is cash out, so we subtract. Okay, so in some sense, this depreciation is smoothing. Capital expenditure smoothing. Smoothed capital expenditure is depreciation. Now, what is unlevered cost of capital? The unlevered cost of capital here, RU, is the cost of equity. The cost of equity if the company has no debt. So it reflects the business risk, pure business risk of the project asset, independent of any financing. So it is often estimated using capital asset pricing model, CAPM, with unlevered beta here. So unlevered cost of equity RU is RF plus BU. Okay, beta of unlevered form multiplied by RM minus RF here. RM is expected market return. RF here is risk-free rate. Then how do we know beta U, unlevered beta? Well, unlevered beta, it is a bit complicated. It is not today's topic. So basically, unlevered beta can be derived. You have to derive unlevered beta from a company's levered beta. When you derive unlevered beta from levered beta, you have to use Hamada equation or similar formulas, considering the company debt equity ratio and tax rate. Actually, Hamada equation is very important. Well, you can easily find Hamada equation. I think it has Wikipedia page. Yes, Hamada's equation. It has Wikipedia page. Let's go to the equation is beta L, beta U, 1 plus 1 minus T, and then phi. Phi is the leverage. So it has a formula. Okay, something like this. Okay, here. Okay, so you apply this formula. Actually, this is better. It is better to understand. Okay, here this part. Okay, the last line, this one. The last line is easier to understand. So if you know beta L, then you can suppose you find the similar form of your target form. Then you know beta of the similar form, but that form is levered. Then you have to unlever it. Okay, then you can get beta U over here by this formula. Okay, remember Again, this is very very important. Hamada equation is very very important. You have to thoroughly know it. There are many problems in Hamada equation. Okay, it is advanced topic, so I will not discuss in detail about the what is the problem of Hamada equation. But anyway, you have to know this. At least this standard version. Okay, so using Hamada equation, you figure out beta u, then you know you are ready to calculate RU because you know risk-free rate, you know expected market return. Now, okay, we are done. So we are almost done. So present value unlevered free cash flow, then it is like this. The unlevered value view is the present value of stream of UFCF discounted at RU, assuming discrete time period and finite horizon T with terminal value TV, then we can do this one. Well, so VU is the sum of expected UFCF over T period, and we have to discount it. And then we have terminal value, expected terminal value, and again we discount it. Here the E thing is the expectation operator. So it is calculate expectation. Now terminal value at time t can be estimated using a possibly there are many ways here, possibly a perpetuated growth model or X in multiple approach. Discounted back to time big T. For example, if we use constant growth rate G for UFCF beyond the period T, then terminal value of expected UFCF is, well, we start with UFC FT and then 1 plus G, then it becomes next period cash flow, and then we have to divide it with cap rate. Basically, it is called cap rate, or unlevered risk-free rate, unlevered cost of equity minus unlevered cost of equity minus G. Okay. Now, if we add them together, now we have this one. Okay. In a continuous time framework, which is I prefer continuous time framework, assuming a stochastic process UFCF, because we don't know it for sure, it is uncertain, that's why we take expectation. We can express VU using risk neutral valuation. Let delta 0 t is a stochastic discount factor from 0 to t, then we have this equation. Well, this is like graduate level valuation. Okay, graduate level valuation, so you can learn this one at the graduate in graduate program in finance department. Okay, now we are done. We know how to calculate the present value of the value creation upon operational engineering. Okay, assuming there is no financing effect. Now we have to calculate the effect of financing, which is often very big, especially when you use a lot of leverage, a lot of debt. Here, present value of financing effect, let's call it PV of FE. Okay, the present value of financing effects here, PV FE captures the net present value of all incremental. This is important. It's incremental effect on value due to financial decision. The most significant positive effects are typically a tax shield. Not always, but you have a tax shield from that interest. Okay. Negative effects can include cost of financial distress, issuing cost, and subsidy or something like that. Okay, so how to calculate present value of tax shield? Interest expense on that is tax deductible. If you pay interest rate, it is off from your taxable income. So for that part, you don't pay tax, right? So if you use that, interest expense is tax deductible, therefore it reduces taxable income and thus tax is paid. This creates a tax shield or tax benefit. The annual tax shield in period T is tax shield T is interest expense multiplied by tau. Then interest expense is obviously that T minus 1 multiplied by today's cost of debt. Okay, so it is like annual tax shield. So dt minus it is that outstanding at the beginning of the period t, or at the end of a period t minus 1. It should be same. RDT is cost of debt in time t. Well, remember, this is potentially important. It is potentially time varying, especially when leverage changes dramatically. Well, when company credit rating change, this cost of that part can change over time. Now, the present value of tax shield is discounted value of this future tax shield. The appropriate discount rate for tax shield is subject to its debate. Actually, I wrote a paper about this one. Commonly, I don't think it is right, but commonly, the cost of debt or unlevered cost of equity or even the risk-free rate are used. The most popular one is this one, although I don't think it is right. Anyway, it depends on the assumed riskiness of the tax shield. If you assume the tax shield have similar risk to the debt itself, we discount at the cost of debt early. Well, assuming that debt level D in perpetuity and a constant cost of debt RD, the present value of perpetual tax shield is simplified to, well, this one. It cancels out, right? Okay, it is perpetuity, typical perpetuity formula. So, well, if we assume the cost of debt and cost of the tax shield are same, and then we assume perpetuity, the present tax shield is simply that multiplied by tau. However, in more general case, which I prefer, where debt levels and the cost of debt may vary over time, and we use time varying discount rate, our tax shield T for tax shield, then the present value will look like this. For each tax shield, again, tax shield looks like this one, and we discount it with tax shield, or in continuous time using a stochastic discount factor specific to tax shield, something like this. Okay, where EQTS is expected under risk neutral measure relevant for tax shield. Well, what is that? Well, it is advanced topic. This valuation, interesting valuation method you only can learn in graduate school. Now, another part, cost. Well, so if we use a lot of that, well, present for the tax shield, it is positive. So as you use more that, we simply multiply it by tau. So, well, the present value of tax shield increase. The more that, the more value of tax shield. Does it mean that we have to use as much debt as possible? That was the original Miller-Modigliani theorem, right? However, in practice, if we use a lot of debt, it incurs a lot of financing cost. Okay, so like financial distress, probability of bankruptcy. If bankruptcy happens, it disrupts many things. It is disaster. It costs. So increased debt levels increase the probability of financial distress and bankruptcy, which incur cost, either directly or indirectly. Well, the present value of this expected cost of a negative financing effect, such as bankruptcy cost, that would be PVFD. Financial distress of PV is present value of cost of financial distress. Well, it is cost, so we put minus sign. Well, quantifying this is very important part. So, however, quantifying this PVFD is challenging. It depends on probability of distress, the cost incurred interest, distress, and the appropriate discount rate. Advanced model might use structural models of default to estimate this cost. In practice, PVFD is often considered more qualitative or estimate using simplified empirical approaches. Well, many CPAs in practice they simply assume it is zero. I strongly reject that idea. I hate that idea. Well, but however, many financial analysts or many CPA simply assume away this one as zero. Next, well, this is another important part which also many CPA assume away zero. Okay, present value of other financing effect, PV of OFA, other financing effect. This can include other financial effects like issuance cost of debt or equity benefit of subsidized debt, agency cost of debt, etc. Sometimes they are very, very important. Each effect needs to be evaluated and discounted appropriately. For example, if the issuance costs are C incurred at the time of zero, then it is a cost of that issuance, then it should be negative, right? So something like this. Now we can put together, okay, then we have a complete APV formula. Combining all components, the complete APV formula is now APV is VU plus PVTS minus PVFD plus PVOFE, which is tends to be negative number. Substituting the expression we derive, well, this one, complete formula. Or in a more general continuous time stochastic setting, which I like in graduate level with this one. Now let's go to the example. Okay, let's consider a hypothetical project with the following simplified projected financial statements for the next 3 years, only 3 years. Usually we take into account 5 years. Here we only consider 3 years. And the terminal value thereafter. Assume a corporate tax rate is 25%, unlevered cost of equity capital is 10%, and the cost of debt is 5%. Well, for simplicity, we assume away present value of financial distress and the financial present value of other financing effect. Okay, hypothetical financial statement in $1,000,000 income. Let's say it is income statement. Well, we have revenue, other operating expenses, excluding depreciation, and then depreciation. Well, in that way, we have EBIT, earning before interest tax, and then we have interest expense. If we subject interest expense, we have EBT, earning before tax, and if we take out the tax, we have net income. Okay, now we have balance sheet. It shows how much debt we have, how much net working capital we have, and then total assets. We don't need that information. Now we have complete information. Oh, okay, I forgot capital expenditure. 15 million per year for year 1 to 3. Every year we spend $15 million. Now calculation of unlevered free cash flow, UFCF. Again, UFCF is EBIT multiplied by 1 minus tau, and then plus depreciation minus change of net working capital, and then minus capital expenditure. Okay, so, well, you can find all those values over there at the top, right? So yeah, you can quickly calculate like this, and then so calculate unlevered value is, and then for year 3, well, growth rate is, assume growth rate is 2%, assume the 2%. So well, terminal value is something like this, $274. Now we can calculate present value UFCF and terminal value, where we discount everything at rate of 10% here. Then this operating part unlevered value is $251.44 million. Next, what is the financing effect? Tax shield interest. This is easy. Well, we have interesting expense. By the amount we don't pay tax, multiply tau. So we have tax shield every year, and then we discount the tax shield with the discount rate of tax shield. Here we assume tax shield, discount rate of tax shield is exactly same to discount rate of debt, which is 5%. I hate this idea, but well, this is the most popular way of doing, so we simply use it. So we discount it like this one, and then this value creation from financing strategy is $1 million. Here it is kind of small because use of debt is small. When we use a lot of debt, it should be higher. Okay, then calculation of APV using the equation APV is VU plus PVTS. So 251 plus 1, so approximately 2.2. Thus, the adjusted present value of the project is approximately $252 billion. The value added by tax shield from debt financing is approximately $1 million in this example, very small. However, sometimes, especially in private equity deal or even private debt deal, in that case, debt is large. In that case, financial strategy becomes very important. So this present value of the part is very important. Okay, so advanced considerations. Discount rate. The choice of discount rate is very important. RU, RTS, which is rate for present value, and then rate for present value financial distress, present value of other financial effects. They are crucial. This choice is crucial and depends on the risk characteristic of each cash flow component. Using stochastic discount factor provides more theoretically sound approach possibly. Now, dynamic capital structure. APV is well suited for situation with dynamic capital structure. Well, when capital structure changes dramatically, usually you should not use NPV. Actually, therefore, I recommend you against using NPV. I recommend you using combination of residual income model of APV. NPV is in most of cases not good tool. Okay, so the debt levels and consequently the tax shield can be modeled to change over time, making APV more flexible than weighted average cost coverage in such cases. Now, modeling financing effects. Accurately modeling and quantifying financing effects, especially PVFD and other less tangible effects, can be complex and then often relies on simplifying assumption or empirical estimation. Risk neutral valuation, which is a graduate class, using risk neutral valuation and stochastic discount factor provide a rigorous framework, especially when dealing with uncertain and complex financial structures. This approach is rooted in arbitrary-free pricing theory. Conclusion. In conclusion, okay, the APV method provides a powerful and flexible framework for valuation, particularly when financing decisions have a significant impact on value. By separating the unlevered value from the present value of financing effects, AP offers a transparent and intuitive way to analyze the value creation process. While the magic formula is conceptually simple, advanced application can involve sophisticated modeling of cash flows, discounted rates, and the financing effect, often requiring a deeper understanding of financial theory and stochastic calculus for rigorous implementation.